Right now, a container is moving. It left a factory in Vietnam, crossed the South China Sea, transferred ships in Singapore, crossed the Indian Ocean, cleared customs in Rotterdam, and is now on a truck heading to a warehouse. Inside that container, the shoes on your feet, the phone in your pocket, or the coffee mug on your desk. You never think about any of this, and that is exactly the point. There is a system behind every product you have ever bought that most people never see and never question. It is built on economics, law, logistics, diplomacy, and documentation. It moves trillions of dollars across the planet every year, and most people could not explain how it works. That changes today. The foundation of all global trade is a single idea called comparative advantage. A country does not need to be the best at producing something in absolute terms to benefit from producing and selling it. It just needs to produce it at a lower relative cost than other things it could produce. Think of a surgeon who can also type faster than any secretary in the office. It still makes sense to hire a secretary. The surgeon's time is more valuable in the operating room. Nations work exactly the same way. Brazil grows coffee more efficiently than Switzerland. Switzerland makes precision machinery more efficiently than Brazil. Both countries gain by specializing and trading rather than each trying to do everything. The result is more total output at lower total cost. That is the engine underneath all of global trade. Trade moves in three directions. The first is importation, when goods or services produced abroad enter the domestic market of a country. Imports satisfy demand for products not available locally or that would be more expensive to produce at home. Importing is not simply placing an order and waiting. It involves negotiating a purchase contract, arranging logistics and insurance, and clearing goods through customs authorities, each stage generating documentation that holds the system together. The second direction is exportation, domestically produced goods crossing a border outward into foreign markets. Exports inject foreign currency into the domestic economy, stimulate production capacity, and drive technological improvement. An exporter competes against producers from every country shipping the same category of goods. That competition demands quality, price discipline, and logistical precision. The third movement, one most people never hear about, is transshipment. This occurs when goods transfer from one conveyance to another while still in transit. A container arriving by ocean vessel may be offloaded at a major hub port and loaded onto a smaller feeder ship, a rail car, or a truck to reach its regional destination. Transshipment does not change ownership, but it introduces additional handling steps, each requiring careful management to prevent damage, delay, or regulatory complications. Global logistics runs on it. Now, here is where most people's understanding stops. They know products cross borders. They have heard the word tariff, but they have no idea how a shipment is actually documented, governed, and financed. Let us start with the three documents that move every shipment in the world. The first is the commercial invoice, the cornerstone of international trade documentation. It is the financial record of the sale. It contains the seller's and buyer's names, a detailed description of the goods, unit values, total value, currency of transaction, payment terms, and the agreed Incoterms. Customs authorities use it to assess duties. Banks use it to process payments. Without a correctly completed commercial invoice, a shipment does not move. The second is the packing list. If the commercial invoice is the financial blueprint, the packing list is the logistical blueprint. It details the physical composition of the consignment, each package, its identification number, gross and net weight, dimensions, and contents.
This document allows carriers and customs officers to verify that what is described in the invoice corresponds to what is actually being shipped. The third is the Certificate of Origin. This one is more strategic than it appears. It attests to the national source of the products, certifying that goods were produced or sufficiently processed in the exporting country. Where something comes from determines what duty rate applies at the destination. Many trade agreements offer reduced or zero duty treatment for goods originating in member countries. The Certificate of Origin is the proof required to access that preferential treatment. 3 documents. One captures the financial reality, one captures the physical reality, one captures the geographic reality. Together, they form the documentary spine of every cross-border shipment in the world.
If this is giving you a new way to see how global trade actually works, subscribe right now and share this with someone who needs to understand it. That is genuinely how more people find this content. Thank you.
Now, what happens at the border? Governments use 2 categories of instruments to control what crosses: tariffs and everything else. A tariff is a tax on imported goods. It raises the cost of foreign products relative to domestic ones, protecting local industries and generating government revenue. Tariffs take 2 forms. A specific tariff charges a fixed fee per unit, $50 per ton of steel. An ad valorem tariff charges a percentage of the shipment's value, 10% of the invoice price. Tariffs are visible. They are published, negotiated, and known in advance. Traders can price accordingly. The second category, non-tariff barriers, is far more complex. These are policy measures other than customs duties that can affect the volume or price of trade. Import quotas, licensing requirements, technical regulations, health and safety standards, rules of origin, pre-shipment inspections. Unlike tariffs, non-tariff barriers often operate through regulatory frameworks that are not always transparent. Here's what most people do not realize. As tariffs declined over 4 decades of multilateral liberalization, non-tariff barriers surged in importance. Today, for many goods, the cost of compliance with technical regulations and certification procedures exceeds the actual tariff rate. The barrier is real, it just doesn't look like a border tax. Who sets the rules? Who decides what tariffs are acceptable and what constitutes an unfair trade practice? At the apex sits the World Trade Organization, the WTO. Founded in 1995, it provides the legal and institutional framework for global trade, administering agreements, hosting negotiations, resolving disputes, and monitoring member trade policies. Its dispute settlement system is its most powerful instrument. When one government believes another is violating trade rules, it can file a complaint. A panel hears the case. Its findings are binding. Non-compliant members risk the authorization of retaliatory measures. But the WTO has faced serious challenges. The Doha Development Round, launched in 2001, stalled on divisions between developed and developing countries. The appellate body, responsible for reviewing dispute decisions, has been paralyzed by political vacancies. The rules-based system is under pressure. This is where UNCTAD enters, the United Nations Conference on Trade and Development, established in 1964, operates from a different premise. Where the WTO sets rules, UNCTAD provides analysis, technical assistance, and capacity building primarily for developing economies. It runs the ASYCUDA Customs Modernization Program that has helped dozens of countries streamline border procedures. It publishes flagship reports on trade and development. It is not a rule maker, it is a development facilitator. In global trade governance, both functions are indispensable. Below the global institutions, regional trade agreements create preferential conditions among member countries. The European Union is the most advanced form of regional integration in history, a customs union, a single market, and a supranational legal order. Trade accounts for nearly a quarter of EU GDP. It's the world's largest trading entity and principal partner for more than 80 countries. When the European Commission negotiates, it speaks for over 400 million consumers with collective weight no single nation could match. In South America, Mercosur, established in 1991, brings Argentina, Brazil, Paraguay, and Uruguay together in a customs union with common external tariffs. In North America, the USMCA, which replaced NAFTA in 2020, governs a trilateral free trade zone where trade had quadrupled over the previous 25 years, with updated rules covering digital trade, labor rights, and environmental protections. Each bloc reflects a different depth of integration. The EU is the deepest, followed by Mercosur, followed by North America's free trade area. But all three share the same underlying logic: member states trade sovereignty in exchange for collective market power and economic stability. Now the mechanism that converts trade flows into actual payments: currencies and exchange rates. When an exporter in Japan sells machinery to a buyer in Brazil, they must agree on which currency to use. That agreement matters enormously because currency values fluctuate constantly. A floating exchange rate moves freely with market forces: interest rates, inflation, trade balances, and investor sentiment. A fixed rate is maintained by a central bank through direct intervention. For traders, exchange rate volatility is a constant operational risk. An exporter who invoices in its own currency may find the value of foreign receivables eroded if its currency appreciates before payment is received. An importer suffers if the domestic currency depreciates after committing to a foreign currency price. The most common risk management tool is a forward contract, locking in an exchange rate for a specified amount of currency to be delivered on a future date. By committing today, a trader eliminates the uncertainty of currency movements over the transaction period. Currency options offer more flexibility, the right but not the obligation to exchange at a set rate, providing downside protection while preserving upside potential. The US dollar remains the world's dominant trade invoicing currency, a structural advantage for the United States that means a sudden dollar shift can simultaneously propagate gains and losses across thousands of trading relationships worldwide.
Global trade does not operate in a vacuum. It operates inside a world of ethical obligations and compliance requirements that have become as commercially significant as any tariff or exchange rate. Export controls and sanctions require traders to screen every customer, supplier, and transit route against government lists of embargoed countries and restricted entities. A shipment that inadvertently involves a sanctioned party can result in severe penalties and lasting reputational damage. Anti-corruption obligations demand policies prohibiting bribery in any form, whether direct payments to officials or facilitation fees to expedite customs clearance. Human rights due diligence now requires companies to identify and address adverse impacts across their entire supply chain, from forced labor in raw material extraction to unsafe conditions in contract manufacturing. Environmental compliance demands alignment with carbon reduction targets, pollution controls, and resource efficiency standards, and the regulatory momentum is accelerating. The European Union's corporate sustainability due diligence legislation is moving ethical supply chain management from voluntary aspiration to legal obligation.
3 things worth sitting with. First, the products you consume are the endpoints of systems of almost unimaginable complexity. The coffee mug on your desk may carry copper from Chile, processed in Taiwan, assembled in China, shipped through Singapore, cleared in Rotterdam, trucked to a warehouse, and delivered to you with next-day shipping. The price you paid compresses all of it into a single number that tells you nothing about how it got there. Second, the rules that govern global trade are not natural laws. They are negotiated agreements sustained by institutions that can fail. When a major economy abandons a multilateral commitment, imposes unilateral tariffs, or weaponizes sanctions, supply chains built over decades can fracture within months. The COVID-19 pandemic, port congestions, and accelerating geopolitical tensions have demonstrated this fragility with brutal clarity. The resilience of global trade is not guaranteed. It is maintained, imperfectly, by constant political work. Third, expertise in this system is genuinely rare and genuinely valuable. Understanding trade policy, customs classification, Incoterms, documentary requirements, currency risk, and compliance obligations is not general knowledge. It sits at the intersection of economics, law, logistics, and diplomacy. The practitioners who master it, who can read a shift in trade policy, orchestrate a compliant cross-border transaction, and navigate a sudden supply chain disruption, are operating in one of the most consequential and underappreciated professional fields in the global economy. The container that left Vietnam is still moving. Its contents will eventually reach a shelf, a desk, a pair of hands. The person who picks it up will never know what it took to get there, but now you do. If this gave you a new way to see the world of trade, subscribe, leave a comment, and share this with someone building a career in this field. That is genuinely how people find this content.